Hello, I'm Richard Divall. I head up our cross-border capital markets team for the EMEA region at Colliers. I've been doing it for 6 years. Colliers is truly global. We're in 69 countries. We have about just under 16,000 employees. When it comes to Europe, we have 344 capital market experts in about over 40 countries. And specifically Germany, we're represented in all of the 7 big cities, have a team of over 70 capital markets. But my specific expertise is traveling the world, which sounds very exotic, meeting capital, helping it strategize and connecting it to opportunities, local partners, and our listings around the region.
Great, thanks, Robert.
Well, my name is Robert Abt. Good morning, everybody. I work for Roundhill Capital for 7 years now. I'm heading there all the transactions. We are a asset manager, investment manager who invests globally in real estate, in particular residential, multifamily, as well as student housing. We currently have roughly 7 billion euros under management. We've active in all the continent, in the UK and Ireland, as well as in the US. We've just started our multifamily business in the US. So we think ourselves as one of the best-in-class residential and student housing operators on the asset management side.
Great, Markus.
Right, yeah, Markus Beran, 7 years with Berlin Hyp as well. Berlin Hyp is a German mortgage bank belonging to the savings bank sector. We have about 500 people in various locations throughout Germany, as well as in France, Poland, and in the Netherlands. These are also the markets we are active in. We had a reopening of an office in the UK lined up in 2016 in May. Waited then, and we are still waiting. We focus on commercial real estate lending only. This is a monoliner. We have one product around that, and can confirm the numbers there. I'm heading the international investors group. We see a lot of traffic and deals coming, particularly from that investor side. And happy to be here.
Great. Christiane, we already know you. Boon Chye.
Yes, I'm Boon Chye, CEO of Singapore Exchange. At the exchange, we provide a single point of access for participants who want to invest in Asia across different asset classes, not just equities, but currency, fixed income, and commodities. We are Asia's most international exchange because 40% of our listed companies and 80% of our listed bonds originate from outside of Singapore. So for our equity market, real estate is one of the very key and core sector. The total market cap of the real estate sector is about 105 billion pounds, and of which the REITs, 44 of them, is about 60 billion pounds. And in there are many international sponsors besides just Asian, and happy to share more in this panel discussion.
Great, thank you. Michael.
Yeah, as you can see, I'm part of the Becken group for at least by now 12 years. Becken is a family-owned company from Germany. Our focus is development in the sector office and residential. We are developing around Germany, but focusing on the top 5 cities. Yes, we will develop in the next 3 to 4 years around 2 billion of assets in those sectors. And beside that, we are running an asset management department for institutional investors. We are a servicer. And Becken Invest is a new company we started 2 to 3 years ago, raising funds, especially for that, what Thomas showed us, the mezzanine debt financing of developments, of our own developments.
Let's look a little bit, Michael, at the macro factors in Germany at the moment. How do you see kind of broadly the sort of economy? How do you see that, and how do you see that influencing real estate?
Well, the German economy is rather good, and it's running up and up the past 2 years. We will see what happens in the future. From my point of view, there is a large impact from the microeconomy to the real estate business. By now, we are very happy because the demand for especially office is very high. That's why our rents are increasing. We have a supply problem in the larger cities. Our vacancy rates are below at least 3 or even 2%, especially in Berlin. So this means there is no space left for office, especially. So that's why we are developing a lot of office buildings, but that's not enough, and that's why we have to focus more and more on redevelopments and existing buildings. But we will see if there's this change in our micro environment. There will be an effect into the real estate business, definitely.
Okay, good. And Richard, how do you think that, how do you see German being perceived by the sort of international clients that you're talking to? Does that also chime with that, or do they think there's a danger of recession, or how do they see it?
I mean, obviously, with the UK and what's going on with the UK, Germany is definitely benefiting from the international community. I just think when it comes to the traditional sectors, particularly offices, you know, they're being asked to pay very low record yields, and international people think, why should I pay, for example, 3% in Munich or 3% in Berlin when I can pay for that in my own market? You know, I think there is great demand. I think Natalie pointed out earlier, I think there'll be far more international money going down what I call the cradle to grave sectors, which is, as we discussed, the more sort of co-living, student housing, senior living in a big way, because I just think core product is very expensive in Germany, and you know, it's very difficult to achieve returns. You know, I think the sophisticated international investors will buy off rental growth because they understand those markets. But people who have offices based, for example, in Singapore or in Beijing will find it difficult to buy just off rental growth. You know, a lot of people do talk to me about what's going to happen with Germany potentially going into recession in the future when you've got negative interest rates. You know, I'm no economist. It'd be interesting to see. But I think the other point everyone's talking about is the potential increase in the RET, R-E-T-T, stamp duty in Germany, which is causing, you know, some initial inquiries about how this is going to do. I mean, you know, any increase in tax is a pricing issue, but is that going to make international people less competitive in Germany? We'll have to see.
Okay, that's raised a lot of potential issues there.
Sorry. Yeah.
No, that's good. Robert, you wanted to pick that up.
I think I echo a lot of what Richard said. Obviously, we still have that imbalance, and I can only speak about the residential sector. We have that imbalance between demand and offering. So, you know, I think that there's obviously a lot of what Michael also said, development potential there. I wouldn't really see from a political perspective, the RET, the real estate transfer tax issue as a big thing, because that's going to apply to everybody, and so it's going to have a, you know, same level playing field effect. So obviously it's going to have an impact on pricing, obviously, but not for the market in its entirety. The problems I see, or the issues we need to address and kind of challenges we face in the metropolitan areas in Germany, is more from a regulatory perspective. You know, the rent freeze which we're having, more regulation coming, which in Berlin, for example, the Milieuschutz specifics, which you know, kind of require a lot of kind of knowledge, local knowledge, to really be a smart and successful investor in these markets. And that's something where, you know, if you open up a German newspaper these days, or probably even the Financial Times have it like every week, you know, the question, how do we safeguard that we also have for the mid-level people sufficient offering of residential housing in the metropolitan areas. And I think that's something which is going to be very impactful for our investments, at least in continental Europe.
And is that influenced at all by the European elections, the outcome of those yesterday in Germany, where you saw particularly an increase in the Green vote and some of the main parties losing some of their impetus?
Well, I think the most challenging issue is that people like, we've seen the Greens winning a lot, the populist parties winning a lot in the various countries. It's just making it more difficult to have a sensible discussion, based on facts and really kind of, demand and offering perspectives. If you look at the discussion we have in Berlin these days, it's really hard to understand from an intellectual perspective to really even find arguments. You have this YouTuber, Rezo or whatever his name is, talking about things and just using wrong facts and not really discussing the problems we have at hand, i.e. the imbalance of offering and demand. So we need to build in Berlin, in Hamburg, in Munich, and have to ease the processes for investors to really enable them to build, rather than to make it more difficult and applying potential rent freezes on new build. Yeah, I mean, who's going to build? And in these discussions, I think it's going to be more difficult due to the elections we had, because even less people having focused on the real issues. It's a problem, and if you only discuss, you have to take ownership from a Deutsche Wohnen. If that's the discussion point, I mean, that's if you want to do this, you can buy Deutsche Wohnen share stock, so you don't have to enteignen anybody, but you just do it this way. But that doesn't lead to any new square meter in a new build. Doesn't change the offering, and I think these are the discussions we need to have also on a political basis, which is becoming more difficult if you have more populists who are just trying for the big win and the big argument.
Okay, good. I mean, it may be useful, Christiane, just for those who haven't kept up to date entirely with the real estate transfer tax issue. Just to highlight that, what is it? When's it coming in? How's it going to influence people's investments here?
Yeah, the German Federal Ministry of Finance has just proposed a new bill to change the whole real estate transfer tax regime by the end of this year. So it's still ongoing, so it's not set in stone, but we expect it to enter into force on the 1st of January next year. And this is going to change the whole regime. Share deals are going to structured. So basically the current partnership rules will also become applicable for companies. And so the current hurdle of 95% will be lowered to 90%. So a transfer of 90% or more of the shares in a company owning real estate will trigger real estate transfer tax. And in addition, the current hurdle of 5 years will be extended to 10 years. So this is definitely gonna change the way share deals are being structured and handled. But I think it won't necessarily impair the German real estate market. So because there will still be ways to kind of avoid real estate transfer tax, I think with the right partner and a good structure, you can still do it. And one example, so we are already working with one client, is it's one of the main developers in Germany, and we are building a model with him right now to secure a development pipeline, but also to make sure that the investor benefits from a real estate transfer tax exemption. So it will still be possible, just more complicated.
And is there something? How does that real estate transfer thing differ to maybe what's already the case in the UK or in other jurisdictions in Europe? I mean, is it something that is an extra burden for people versus investing in France or the UK, for example, or is it just a rationalisation?
I don't know the benchmarks of the other jurisdictions.
Natalie, do you want to pick that up just in terms of?
Not German word.
No, but I mean in terms of.
My understanding is you compare it to like Australian market or UK, where you capture land-rich entities that kind of bring it in line with pretty much standard practice. But it does change the dynamics of the German market, which has had a bit of a freak hit, if you ask me.
I mean, let's put it clear. The real transfer tax is when a property sold is due. That's in every country the case. What was an exemption was for main companies owning their own premises. And if they inherit or sell the company, they should not be penalized in their normal production line with additional taxes. The real estate industry took advantage of that and captured that and made a tax avoidance scheme. And that's what people saying, the rich ones who can afford these kind of structures don't pay, and the normal buyer of a house has to pay. And that brings this imbalance, and that brings this discussion, particularly if the market is tight as today, onto the particular arena.
Okay, good. Yeah, Michael, yeah.
Maybe what are we talking about? So we're talking about 3.5 to 6.5% of tax to be paid by the buyer. So regarding larger assets, there is an impact. For example, buy something for 100 million, you have around, let's say, 5 million of tax to pay. So regarding the market and the cap rates, it does have an effect. From my point of view, yes, I agree that lawyers will find special ways to avoid, again, this transfer tax. My first discussions with our institutional investors show that it will be rather complicated, and especially the duration time of 10 years holding period for the shares is a very unlucky thing for the investors. So from my point of view, we will see less share deals in the future. That's my personal opinion.
Okay, I've got a couple of questions that I just want to bring in. Thank you for those. One of which is on what happens to returns when cap rates move from 3% to 4%. That's one question. And then there's another one, which is how do investors price in rental growth when they might not be able to capture it for 10 plus years due to the prevalence of lease prolongation options?
Germany is deemed a very, very expensive market in Europe, but the fundamentals are fantastic. I mean, everyone is chasing returns at the moment, and there's so much more money for that sort of core plus value add part of the market where people can achieve returns. The Koreans are very active, for example, all over Europe, but they need 6-7% returns over a 5-year period. So they are looking all over about 4% entries, which is very difficult to get in the main German cities for offices. It's easier for logistics, but whether the scale of logistics is there. But if yields do move out, then it would make it more interesting for a lot more people.
Okay, good.
Maybe I could just add from the standpoint of the Asian investors. So yeah, when cap rate goes up, clearly there's a challenge on the return. But in our marketplace for the REITs, typically most REITs do well when they have a diversified geography spread. And while Germany is a scalable, large, developed market, we do have European REITs that are across different countries. So obviously that diversification does appeal to our investors. And even when a single country's cap rates adjust upwards, I think that diversification does help to cushion some of the blow.
Okay, good. And it would be good just to pick up as well with you, Boon, if we can. Let's look at how European markets are perceived by Asian investors and also how they perceive Germany within that.
So our REIT market has a reasonably long history. Started off in 2002, so that's almost 17 years now. There are a total of 44 REITs. It really first started out with Singapore sponsors who were looking to monetize their assets. But by 2014, in the last 5 years, we've really only seen international assets being put into a REIT and listed in Singapore. And Europe is one of the regions that appeals to our investors. And Germany is a core part of that. And they recognize, obviously, with the developed market and the kind of scale, cap rates are lower. So generally, the portfolio would have a mix of different asset classes in the different countries. And besides that, the investors are also looking to try and invest in euro. So we offer listing in the euro currency besides the US dollar and Sing dollars. So Europe, Germany included, is well received by investor base in Asia.
Okay, good. And in terms of other capital. What new capital are we seeing at the moment? We saw there from Thomas in his presentation some of the capital flows. Oh, and by the way, we can make that available for you. That slide, all of the slides that Thomas has done. So I'll put those on the website, and then you can download that as well. We saw their Swiss capital, various other sources of capital. This is to anybody really. What sort of new capital are we seeing? What's happening in terms of the capital flows, capital sources coming into Germany? Yeah, Markus, you can.
We see, well, whenever we get a loan request, we see a different type of inflow. American money hardly there at the moment. The trend is towards Asia, South Africa and Australia coming there, Malaysia and Korean for overall. Having compared that to 10 years ago, they learned to team up with They teamed up with local asset managers with local expertise and not going into direct investments, and that makes this joint venture structures, and that makes it also more difficult to measure. Do you talk to the asset manager or the investment manager there, or do it directly to the investors themselves? We've done a scheme there where we had the local investment manager in Berlin, and we had Korean, like a fund coming in, and they sold their fund to different investors, and they have 5 times presentations to people coming with delegates from Korea just to look at the asset, to look at the partners, to look at the valuation team, to look at the bank, to look at the site. They were there for 2 days and went back, and we had this presentation 5 times for one investment. So we went through, I think, 50 people to explain how the market works, how we as a bank work, how the lawyer works, and how the valuation works.
But 5 different from Korea, or 5 to all? Okay.
All for the same assets. They invested into that main fund there, and we've given 5 times the same speech. It was interesting.
Maybe I could add to the different sources of capital, and to point back to the earlier question on if cap rates were to go up from 3 to 4%. I think broadly speaking, Asian long-term capital in the form of pension funds and sovereign funds have in the last few years tried to increase allocation into real estate. Obviously mindful of potential cycle changes. At the same time, the allocation has not been caught up because of valuation changes broadly, portfolio going up. So probably would still be below in some way benchmark. So I think in any potential correction, you probably would have some support from some of this long-term capital from Asia.
Good, Michael, you want to pick that up as well?
Yes, what we are seeing is that in the past years, the US money has left Germany because of the slow cap rates. There is money coming from Middle East, from Asia, but my impression is that those investors are still, I don't know how to say it, a bit picky. They are looking for the right asset. They are afraid of making mistakes. But we have a large impact of European money. So there is a lot of European money, for example, from Scandinavia coming into Germany. Pension funds from Denmark with very low cap rate expectations. And they are positioning, let's say, next to our own German institutional investors. So, and there is a kind of a transfer, because this group of investors more and more now are switching from, let's say, this core asset profile to the core plus value add, and I think we will see a transformation in those categories in the next years.
Okay, good.
I'm just stating the obvious. What Thomas said earlier, I think it's also a phenomenon which we see and which totally makes sense, that German institutions, right, are more and more focusing on more real estate because they don't have any bonds they can buy at the yields they need for their insurance money to pay ultimately to which they promised 10 years ago to their clients. And I think that's a big part of the money which is still kind of flocking into the real estate market, which used to go into the bond market. So alternative investments as the broader schemes called. So I think that's what we see at least very, very strongly in the real estate in which we are active in. And Allianz would have never bought student housing or niche products 10 years ago, and look what they're doing now, or the BBKs of this world. I think that's at least what we see active.
I mean, North American money, as we've discussed, is in very early, needs high returns. Everyone classes North America as US really, but Canadian pension fund money is really looking to go outbound. The difference is, their prime yields are 4.5%, so they're not going to buy in Germany at lower yields unless unless it's a done deal like a Sony Centre or something like that. So I think there's going to be a whole wave of second-tier Canadian pension fund money. The likes of Quadrille, which is the British Columbian pension fund, is late in the day in comparison to Oxford Properties, for example, which is Toronto. They set up offices in New York, London, and Hong Kong to become the main investors now, putting 90%. So I think you'll see them going around Germany. No one's mentioned the Japanese. I think the Japanese, which has a great affinity with Germany, will be very, very active. The big pension funds will probably go indirectly, so you might not hear of their names, but GPIF, the big government pension fund, is looking over the next 10 years to invest 65 billion into real estate and infrastructure. And you'll see that going through probably CBRE Global Partners, who I think they've given their first real estate mandate to. The Australians are back, so we're all joking that we must be at the top of the market if the Japanese and Australians are here. But I think, generally for Germany, I think we're going to see more Singapore capital entering that market this year, the Capital Lands, the Keppel Capitals, the Ascenduses, etc. So I think that there's a whole wave of capital there. It's just, how does it do it? Does it do it indirectly? There are language barriers, etc. It's not as easy as some markets, but I think it's all very focused on Germany, and we'll probably see a lot more Asian capital going in, but it might go indirectly.
Okay, good. I've got some more questions coming in, so I'll try and deal with those as well. Michael, just a quick one here. You mentioned about the macroeconomic factors that were having effects for you and the German real estate market. Can you give a couple of examples of that? Was one of the questions that's just come in.
Macroeconomic factors, yes. So let's say if we'll run in kind of a recession in Germany, this will have an effect on our real estate business. So that's why our strategy regarding office development is we're focused on the top 5 cities. Because if you're regarding, like, let's say Frankfurt, Hamburg, Munich, Berlin, Düsseldorf, these are the top 5 cities. We have space, a transaction a year of, let's say, about 700 to 1 million square meters. So it's a lot. If you have microeconomic problems in the German environment, I would say the effect will take place first of all in our B cities. So that's why we are focused in our A cities, and the effect will be that we will deal then more and more with vacant spaces. Because companies will start to. That's the problem in Germany. The most important issue in costs of companies are like the people working for the companies. But the first point companies are reducing is the space they are renting. So we will see. For the case there's a recession, will have an effect in the office sector.
Okay, good. Not much mention, point that's just come in, not much mention of Chinese capital coming in. Is that due to Chinese capital having a block from the government, or what's the situation?
I mean, from my point of view, we're starting to see Chinese capital get interested again in Europe. I think the key point is it's going to come back in a different guise than it did. So they won't be buying trophy football clubs or trophy hotels. There will be more controls. My understanding is they're going to be following more the Chinese Premier's One Belt, One Road, so probably going more into logistics, business parks. So areas in Germany like Duisburg, I think will be a real beneficiary of Chinese capital going forward, being that inland port. But it's also senior living is very, very important to the Chinese. So I think we'll see a lot of that capital going into that sort of cradle to grave as well.
So why do you think Duisburg would be a hub for Chinese capital?
Because of the One Belt, One Road strategy.
All right, gotcha.
Yeah,
All right, okay.
So I think everyone's tipping that to be a very focal point for it.
Okay, that's an interesting
Well, that's right. I don't know.
yeah, we'll see.
I share that comment, and I think the One Belt, One Road clearly is attracting the kind of investments. But secondly, also because of currency control, is harder generally in terms of investing outside of China. Obviously, there are big property groups that have made investments in the US and Europe. And also thirdly, China in itself is also an attractive investment destination. So there is also a lot of recycling of capital domestically in China. We have seen also some of those assets being monetized by a REIT structure on the Singapore Exchange. There have been now 4 Chinese REITs, largely centered around commercial and retail.
Ah, okay, interesting. And in terms of the flows of capital, there's actually quite a bit of German capital coming into the UK. What are you seeing in terms of UK capital moving into Germany? Anybody can pick that up.
Yeah. Well, I mean, UK capital is pretty active around continental Europe. So, I mean, M&G, which is probably one of the largest UK institutions, 3 years ago, 90% of their portfolio was based in the UK and 10% in continental Europe. They're trying to change that at a global level to do 50-50. So, for example, M&G have bought 13 offices in Germany over the last couple of years. So, yeah, no, I mean, Aberdeen Standard have got a completely different strategy, going down more residential development, and have been very successful in that area and have got in. But, you know, they've all got logistics funds, etc. So, no, I think the UK, with what's going on at the moment, is driving quite a lot of that sophisticated UK money onto the continent.
Okay, good. I'm going to come to the sectors in a minute and pick up those. But Markus, just in terms of the financing side, Thomas mentioned that some of the banks were becoming more critical. So you are a bank, what's happening?
Yeah, the assessment of a bank is a kind of a co-investment into that structure. So they need to make sure that the money that we take from other people and then give it to any investor comes back. If the cap rates are low, there is fewer money to serve the debt. And we need to make sure that once the loan expires, that there is a sufficient debt yield on that loan, that in case of an interest rate rise, it will still be served from the rents. So the assessment today is less than LTV or an ICR coverage, but what is the debt yield at exit, and how strong and how stable is the rent underlying for that investments? The assessment of the risk for any loan has changed towards that.
Okay, good. And maybe to you, Christiane. I did a session with EPRA about a year ago, which was on green financing. How's that influencing the market there? Is that becoming more profitable, I suppose, for people to finance via that route, or what's the position?
Yeah, I think what we see in our practice is that green lending, green financing is becoming more and more important. And as already last year, it's not that banks, lenders are not only looking at building certification, but also continuously on the performance of the building, so energy consumption and, for example, CO2 emissions. And you mentioned M&G, and they published a research study last year in November, and they actually confirmed that they looked at their the portfolio and compared the certified part of the portfolio with the uncertified parts. And in the end, they came to the conclusion that the certified part led to higher distributable yields for the investors. And one reason that was higher rents and better conditions lending, lower interests. And so this is one piece where it's been confirmed.
Okay, good. And Robert, in terms of some of the other, I mean, we've been doing quite a lot of things, whereas financing had appeared as a large part of every conversation for a long period of time. Actually, increasingly, well-being, those kinds of what would have been viewed as softer factors, or in fact not discussed at all until a year ago almost. Particularly well-being has come into the frame a lot. Is that something that you're seeing as well in your kind of world?
Well, I mean, I think I would echo what Christiane said. I think we see a lot of efficiency driven either by digitalization or modernization of the buildings, and you have in particular the millennials crowd to really appreciate that and pay higher rents. If you have a more efficient building, if you have more services attached to it, it's more the community theme, I'd say, and community having an economic perspective, ecological perspective, and a social perspective. And I think these things kind of provide value to residential buildings and student housing, obviously even more so. And that obviously has again an impact if you can deliver that product more. And look at as and we never speak of tenants, we always speak of clients. If you kind of provide that as a more product, I think that's appreciated by banks and all stakeholders really.
Okay, good. And Michael, there's a question here as well that's coming particularly about construction costs. And from the development side, if construction costs are increasing, but rents and yields are relatively stable, is that having an active impact on the development side?
Yes, indeed, there's an impact. We have an increase in construction costs. We're seeing in the past 3 to 4 years of at least, let's say, 35%. But on the other hand, the rents are going up. So that's for the moment. It's not that bad for us because the increase in the construction costs is covered by the increase in the rents and then the increase in the multiples paid for the buildings. So everything is fine by now. We'll see what happens in the future. The larger problem regarding construction is not really the cost issue, it's the supply issue. So many developers are having problems of getting construction companies to finish their buildings. So and that's the problem. And the construction companies, on the other hand, they have problems to get employees, to get machines, and all the stuff you need to build. The funny thing about is that the duration in this construction phase is a bit similar to the duration for your permission to build something. So it's more or less the same. You can do it like both ways, and afterwards everything is going to be good. But I would say we will have a kind of a problem in the future. And you see in Germany more and more developer they are not even constructing any longer. So everybody is like trading, and especially regarding Berlin, everybody's waiting for the buildings to be built, but nothing happened.
I mean, it's interesting. Let's pick up on Berlin while we're there, because we've also had some questions coming in around the issues with residential rent caps, potential nationalisation of some of the housing stock, those kinds of things. So let's pick that up. But I'd also like to just see people's views in terms of Berlin versus the other cities, because it seems to me that Berlin is one of the few cities where there's actually room to grow as a city, and obviously it was a very substantial city in its past. So who wants to pick out those pieces?
Yeah, so maybe to pick up Berlin and our other cities. So I'm a German, and well, regarding Germany, for me, we have like our 5 biggest cities. Berlin has, or regarding the past, Berlin is the fastest growing city in the past years. But I won't say for the future that Berlin will be the city in Germany, like for example London in the UK, because the other cities, every city in Germany of those 5 cities has special companies, special issues. For example, for Berlin, it's not possible to transfer the harbor of Hamburg to Berlin and to get all the companies moving to Berlin. It won't happen. A similar thing is like Munich. You have all the stock exchange companies located in Munich, or let's say 2/3 of them. So this won't happen as well. So from my point of view, like Berlin has a huge potential, especially in the new business sectors. But we will see that that our other cities will like develop the same way.
Okay, good.
Can I ask just a question? Just on Berlin, on new sector, are we talking about new economy, fintech coming up in Berlin?
Yes, I would say Berlin is very famous in Germany for the new sector. So we have the startup community is very strong in Berlin, and we're seeing a lot of international companies in Berlin just because of, well, Berlin is our main city. And the funny thing about Berlin is that you have like very high quality buildings, and we're seeing average or high rents of at least 30 plus euro. But regarding the startup sector, except Zalando, nobody is able to pay such high rents. So it's very. I don't know. I don't know what will happen in Berlin, but we will see in the future.
Well, sorry, you go ahead.
I was just going to say, I mean to add, all my colleagues in Germany are exactly saying the same thing what Michael says. I mean, when I speak to international investors, they look at Berlin as it's the largest city, it's the most international, multicultural city. It's got the tech and media occupiers moving to that city, but more importantly, it's the most affordable German city. So the young people are moving. So the talent is moving to Berlin because it's affordable. And if the young and talent is moving there, then the occupiers will move there. Now, we'll have to wait and see. And it would help if the new airport did open, I think, to become more international. But, you know, I mean, we're selling a value-add office portfolio at the moment in Berlin for sort of 250 million plus. You know, 2 vacant offices in Mitte, 2 short-walled offices in Kreuzberg. And, you know, we went out to probably 90 people, and we've got literally 87 NDAs signed. I mean, we could have gone out to probably another 150 people and get it all done. I mean, it is, from an international perspective, everyone wants to go into Berlin because of those reasons, really.
Yeah, I mean, obviously I echo a lot of what has been said, but I think also the German perspective also has always a little bit of a negative connotation, because Berlin was always like the dog within the 5 large cities, and the Germans kind of always still have that kind of perspective. We obviously invested in German residential real estate for 20 years now, and we love Berlin, and we made a lot of money in Berlin. We still invest in Berlin, and we should never forget that the base in Berlin is so low. Yeah. And what you said, it's so true. Talent. If you ask, young talented people, where do they want to live? If they have a global perspective, they go London, New York, still, things. Lisbon, as per Thomas chart, top cities. I think Berlin is still very much on top of that list. And if you look at the residential house prices, everybody's like complaining that they're so exploded. And if you compare it to Munich, where truly there's more DAX companies in Munich than there are in Berlin, but whether the DAX company is going to be the companies of the future, I would put that as a question mark. And you have rocket internet, and obviously the Germans again have a very negative connotation to all startups, and that's one of the problems I think we have in our economy, that there's not sufficient drive and energy to ultimately go at risk with your capital to a certain extent. But I strongly believe in Berlin, as you can feel, I think, and talent is there. International companies are going to their public sector is huge, obviously in Berlin. And we still have a average rental base of, I think, seven-ish euro, in a capital city in Europe where talent is dragged into. So for me, that's still very much a growth city and a super interesting city to invest in. Having said that, obviously you have to be very local, have to be very close to the market, understand what rent restrictions mean, what does happen if you modernize, and depending on the regulatory environment, if you do have to modernize, at construction costs increasing, can you put some back to the tenant? Is that something which will be restricted in the future, even more than it is restricted at the moment? Our rent increases, which are already currently limited to a certain percentage over a certain period of years, and then also capped by what we call Mietspiegel, which is a reference object. So these are a lot of things which you have to keep in mind if you want to invest into that asset class, and believe in the growth. But then obviously you have to see what rent freeze could mean, and what that means for developments. Currently not relevant, because for new developments the rent freeze does not apply. But what does it mean? If you renovate it or convert office to resi and what have you. So what I'm saying is you have to be very local, have to be very careful in monitoring what's happening on the regulatory side of things. And but then I think Berlin, compared to Munich and Hamburg, for example, has a great advantage that there are still spaces, right? I mean, to Michael's point, the negative thing about these spaces is that a lot of developers currently buying and just hold to it and land bank it. And obviously there's a lot of political discussion also on this, and I think rightly so. That developers may have to develop if they buy and not just speculate with it. We have a strong municipality in, I think it's Freiburg, where Boris Palmer is the current mayor, and he urges the developers in his own municipality to build, and if they don't build, they have to pay penalties. Whether that's the right structure, it's very questionable. But I think that's the good thing, is that you do still have land in Berlin, which you can grow within the city and kind of produce more offering.
Freiburg is maybe a nice example towards Berlin. Berlin is not only a city; it's also a country.
Yeah, true.
So they have the Senate, and they have the very boroughs out there, and there is no aligned interest in that. So penalizing someone who wants to build and doesn't get the building permit is not the right thing. They have reduced the administration. The getting a building permit takes forever, and there is a backlog of.
No, totally. I think I totally concur with that. I mean, obviously that's what I said. I think the very initial statement, you have to really, on the political discussions, we need to ensure how can we build modern buildings and with good ecological perspectives, but also be fast in it and provide the offering which is now demanded, and not kind of wait for 10 years and have nationalizations discussions. Yeah.
I want to make sure that there's time for some networking and everything afterwards, and for you to ask questions directly to the speakers as well. But let's just do a quick fire route through some of the sectors. Logistics. We've heard about One Belt, One Road. E-commerce, is that growing there? Is that going to be the key driver for logistics? Anybody want to pick up logistics?
The small size logistics is the new retail, right?
Yes.
No. I mean, for logistics is a popular sector amongst our investors on the exchange. Australian logistics sector, Germany and Europe. So it's clearly an appealing class.
Okay.
I think logistics is the sexy traditional sector. I think there is more growth. I mean, the UK is the sort of most mature UK post-digital market in Europe. I think we're about 20% of consumption at the moment. I mean, interestingly, the grocery e-commerce seems to have plateaued, and we saw some American investors come in and do a deal of 450 mil with Sainsbury's 2 weeks ago, which I think is very encouraging for the retail sector. But I think for logistics, you don't get the same rental growth as you do in other countries around Europe, in Germany. However, the fundamentals, I think it's still a good bet.
Okay, good. And retail, I mean, including in Thomas's presentation, but also questions coming in here. Negative viewpoint, but what's actually the situation on the ground? Is there a lack of interest, but also are the assets still performing?
I think the leases are long and they're out there, but the last times we don't direct investors, we only see the requests coming in from those who seek loans. That basically has dried up over the last 9 months. So we saw portfolios trading, we saw big schemes trading, but the last 9 months, almost nothing. And our pipeline is next to zero what concerns retail investments or even developments in there.
So you've seen no request, no interest at all?
No, I mean, I think retail's probably a bit behind the UK and Germany in terms of I think too many institutional investors in Germany have sat on retail and not done anything about it. And I think, when I visit New York, that's a general question of why have you Europeans just sat on this? You all knew it's coming. Why haven't you addressed it? And I think we've been too slow, or we've built too much. It isn't. If you're selling the best in class retail and you can see that people have actually spent capex over the last few years, then maybe people would consider it. If people have just sat on it and done nothing, and there's a lot of capex to do going forward.
But what do you do if you own a portfolio of Lidls throughout Germany? You have a lease of 10 years. The capex is paid by the tenant. There's hardly anything you can do about it. You just see the lease length is shortening and your value is decreasing. Then you need to wait that you can extend the lease to sell it again. So that's why when we have the right pipeline, I think there is also hardly any trade in that asset class at the moment.
Yeah.
And also the alternative sectors. I mean, before, when we were looking at this kind of 2 years ago, people's view would very much be, oh, well, that's just the sign that the market is quite at the top at the moment, and so people are looking at these alternative asset classes. But that seems to be changing in terms of the types of capital that's going in, the lending that's being done, and the ability to be able to actually put portfolios together. But where do you see that for Germany if you're looking at student housing, micro-living? Interesting to see data centres on your presentation there. Yep.
Well, from my point of view, those sectors are still niche products. So like the main capital is going into residential and office, and I would say at least more than 80%. So we're talking about 20% of capital running into those niche sectors. And there is indeed a hype regarding logistics, especially in the past. But as I said, as a niche product, as well as the co-living, student housing, micro-living, well, you have different names for at least the same kind of building. It's living in very small units. And the one, there is a student housing brand on it. Robert, correct me if I'm wrong. On the other is, I don't know, senior living. And but finally, it's a flat with 20 square meters and an operator sitting in the lobby. So this kind of product is, from my point of view, a niche product, but it will work. And what we are seeing, that more and more institutional investors are seeking for such a kind of product, just as you said, to have it in the portfolio as an add-on on the, I don't know, boring core office or residential asset.
It's also a reply to the shortage of housing. Right? You have, for example, there's a zoning for commercial real estate. Somebody builds micro living on it, makes a master lease, so he's a commercial trader, and then rents it out as a flat. That is actually against the idea, But because of the shortage in the housing market, these schemes are accepted.
Yeah.
But nobody wants to live forever in 22 square meters. Yeah? So it's young people coming there, startups being flexible, but then once they're there, then they try to move on.
No, I think it's what we've seen in co-working with WeWork. What we haven't anticipated 10 years ago in residential now, and that's I think exactly the same development. I agree with you. It's still a niche product, but I'm strongly of the opinion that this will become a larger product and be a more institutional asset class, and that's why institutional investors are flocking into it.
Okay, good. And Boon, just to you briefly, you're obviously here in Europe. So, correct me if I'm wrong, but the situation is that there's interest, particularly from holders of German assets, in then seeking a listing on the Singapore Stock Exchange. Why is that? Why that interest? Is it because there's more interest from Singapore-based investors, or what's driving that?
Well, the investor base out of Asia, out of Singapore, are used to real estate as asset class, REITs in particular, and then obviously the international nature of those assets. But I think importantly, for the sponsors who are looking to list on an exchange, there are a few advantages. One is the tax transparency. So individual investors, whether you're local or foreign, do not pay any withholding tax. Institutional investors only pay 10%, which is generally lower than what most other jurisdictions. And then two, very importantly, is the concept of the external manager, which to a sponsor that's attractive, that's well accepted in our regime and marketplace, so you can continue to actually earn and enjoy the fees managing those assets and continue to grow with that. In the last 10 years, the CAGR of the REIT sector has grown by 22%, so it's a very attractive sector.
Okay, good. And let's just try and wrap this up. So, Richard, let's start with you. So, if everybody here was going to invest their valuable money, where should they invest it? You can choose a sector, you can choose a city. Where do you think the opportunities are at the moment?
Well, I mean, I think anywhere around Europe, but specifically probably in Germany. It's all mixed use in cities. I mean, this whole urbanisation trend, what the occupiers want with living. So I'm a great believer that if you invest into mixed use CBD opportunities, it will look good in the future.
Okay, good.
I think it's very much residential. Continues to be a very thriving investment asset class, and obviously, you can't do anything wrong in Berlin. That's I think something which I strongly believe in. Obviously, as I said earlier, with all the caveats, but also Frankfurt, Hamburg. If you look at the opportunities and don't do it with a wide spread, without any focus, I think you still can do well also in B cities in Germany. Okay, good. Markus?
Well, just would agree, because with the trend of urbanization, with cities growing and the countryside drying out, that the demand will be there for a longer future. So we can't do nothing wrong in going in resi there.
Okay, resi, great. Christiane?
In my opinion, I think it's true for investors of all asset classes is to really figure out, to look at how to expand the service offering to tenants while taking stricter climate protection targets into account. Tenants are increasingly asking for flexible, high-quality real estate solutions. We spoke about the success of the Green Party on the weekend. We have tough climate protection targets in the European Union, in Germany as well. And so this is worth looking at and taking into account. This will even be stricter in the future. One example for this is we see increasingly in the German market is, Robert, you mentioned it, the service is being provided to tenants. One example is, for example, the supply of energy generated by renewable energy sources or e-mobility concepts.
Okay, great. Boon, Chye, where do you think people should invest?
Just from the, I think, equity investor standpoint from Asia, for Germany, core, stable asset class, the office is always demanded. But I would say it has to probably be coupled with some diversification into other sectors like logistics, maybe student housing, and then some country diversification.
Okay, great. Michael.
Well, that's interesting because picking up your question referring to rents, I would have a view on our core plus value add assets, because from my point of view, we will see better increase in rents in those objects, not CBD, not core, not high street, because they are already at a high level regarding the rents and the multiples. So there won't be that much of increase, maybe in Berlin, but in the other cities not. So if you have a look on office buildings, like say 1B location, where you have average rents around 11 to 12 to 13 euros. That's from my point of view, this kind of asset, it is more expensive than 2 years ago, but it's the kind of asset that where you will see an increase in the rents of, let's say, 3 to 4 to 5 euros up to 16, 17 euros. For me, that's an interesting investment, but you should stay in, as I said, the main cities.
Okay, great. Thank you very much. Thank you very much.